All right, what's happening, guys? Welcome to another episode of Sensible Investing, the deepest stock market research channel on YouTube. Today, we're going to go through all of the stocks which I bought and sold in January and February. As you can see with this whole coronavirus situation, everybody has lost their minds a little bit. And when you've got headlines like these where people are getting tasered because they're fighting over toilet paper, it just makes you think what's gotten into the heads of a lot of people, where I think the media has created a lot of sensationalism, which creates good opportunities like us, for you and I, to really find bargains. And guys, before we get into it, if you're enjoying my content, getting good value out of my videos, and are learning something, I'd really appreciate it if you'd hit the like button, subscribe, share the video. It really helps my channel grow, and it helps me to make more content like this for you in the future. First stock, Canada Goose, my lovely little Canada Goose, which I made a video about that I reluctantly sold back in January of this year. And if you guys have seen some of my previous videos researching Canada Goose, I was really bullish on it, and really, I still do like the company. But as you guys may recall, because of this whole coronavirus situation, and especially China, which was a massive part of the bullish thesis in terms of buying Canada Goose, I reluctantly sold my Canada Goose at a small loss, as you can see. So if you add up the different units and then sort of come to the numbers, I think that was about an average purchase price of about $35, $36. So a little bit of a loss, and again, really didn't want to sell the stock, but it was the right decision, because as you can see, fast forward 2-3 weeks later, it's gone down another 22.5%, and I suspect it'll trend down some more. And so this actually provides a really good opportunity to buy back into Canada Goose at a point in the future, considering that it IPO'd at about $17, and this was about 2 to 3 years ago, and the company has grown, I'd say effectively doubled, almost 2.5 times where they were when they IPO'd. So effectively, the price has trended way back down, and I think the selling is a little bit overdone. So I'm keeping my eye out on Canada Goose, waiting for it to go a little bit lower. I think under 22, I might start buying back a little bit, and then if it goes under 20, then I'll start buying back quite a lot more heavily, because although China is a big part of the Canada Goose growth story, it still only accounted for about 20% of their revenue, so their business is still intact, and people are still loving the brand overseas. Okay, guys? So that's Canada Goose for you. Next up, QDN. I don't even want to talk about this stock. Okay, this stock has been the bane of my existence, right? So I sold out the rest of my holdings in January, but as you guys may recall from some previous videos that I made, I actually ended up halving my position, right? So this was probably the biggest mistake I made in terms of my investing. However, the good thing is I never went too heavy with it to begin with, because it was at no point in time was it more than about 3-4% of my portfolio. So what I did was, back when it was $6.89, high sixes and the sevens, I got rid of half my position, just because I wasn't too sure what was going to drive the stock up. If it kept on beating and raising their guidance, and yet it wasn't going up, right? So when sentiment is that bad, then I don't know what's going to drive the stock up. So I sold half my position, and then as you can see, I sold the rest of it back late January. So took a bit of a big loss on that one. Not big as in dollar-wise, but percentage-wise, it was a big loss. Good learning lesson. And really, if I was to do anything differently, I would say that I probably should have sold it off a little bit sooner, when they came out with their most recent earnings call, whereby management actually withdrew their own guidance. And that there is a bit of a red flag in terms of a leading indicator, because if management don't even know what's going on inside their business, then there's no chance that we will know what's going on inside their business, especially with a big black box like China, where there's no leading indicators. All right, guys. So the loss I took on that, I mean, it's still good, right? So I sold, and because I had some of my subscribers saying they're still holding, they're still buying, and it just keeps going down, and there's just a lot more pain. But the right thing to do probably would have been to sell back at $5, where management said, look, we can't provide you guidance, we're withdrawing our guidance, but we are going to try and buy back more shares, but then it's going to be over 30 months, all right, guys? So if we add 2 and 2 together, it doesn't really make sense. So that's what's happened with QDN. Okay, guys, now let's move on to a brighter note. So Afterpay, as you guys know, if you've been following my videos, this was my biggest position in Australia in terms of my Australian share market portfolio, and I did really, really good on this position, right? So I started buying the company when it had dipped, as you can see over here on the 4th of April, where people were saying Visa is coming out with buy now, pay later, and then they sold the stock off into oblivion. Okay, so I opened my position way back at about $23, and what happened was people had sold the stock off, and I kept on buying Afterpay. And as you guys can see here, the transaction on the 29th of January, now that one was actually a share purchase allotment, whereby they did some capital raising way back in June. But what happened was they froze the capital raising because in Australia they were being investigated for potential money laundering issues. But again, guys, I made a video about that saying why this was essentially bullshit, because the average transaction value for Afterpay is about $170. So you're going to have to convince me how people are going to launder millions of dollars, whereby, you know, people's accounts don't even exceed $1,500 and the average transaction value is $150. Anyhow, guys, so what I did was I sold my position on the 7th of February, and as you can see, I sold it all off at an average price of about $39.40, and my buy price somewhere around $25. So it was a good play on that. And since I've sold, it's gone down sort of 16-17%. And the reason why I sold off Afterpay was because I wasn't too sure what the market was pricing in, right? We have very high expectations. All of the brokers were saying they're going to beat expectations, right? And then if you look at the forums and what everybody was talking about, it's like, you know, everybody's expecting a beat, everybody's priced in a beat. Even if you do have a beat, it's like, unless it's a huge beat, which my research just didn't support, then I didn't really see any need to hold on to the stock. So that was a pretty good move, and it's continuing to trend down because, you know, obviously with the whole coronavirus situation, but also Australia's economy is not doing too well at the moment, right? So, but I think Afterpay is going to do well because US and the UK is going to just take over in terms of the merchant numbers, the people buying, the repeat purchases, the basket sizes, the number of purchases per purchaser. So I think there's a lot of good tailwinds going for Afterpay. So I'm looking to try and get back in maybe under $28, 26, 27. I think that would be good time to buy back in. So yeah, did pretty good on Afterpay. All right, guys, next stock. So Oceania Healthcare. This company is actually a company that this was the very first stock that I ever bought. Okay, guys, so I started investing back in June 2018. This was the first stock I ever bought, and it's a retirement village whereby they provide premium retirement care services because the funding model in New Zealand is pretty poor. And so they provide premium care services, and their value-added proposition is that you get premium suite. It's all in one place. You don't need to leave if you have any issues to go to hospital because they're qualified nurses. You've got good premises, chefs on site, you know. So it's basically somewhere where you can go, retire, be happy, have your health issues, and, you know, well, essentially die, right? So it's like that was their value proposition. Anyhow, guys, so I sold the stock. So I bought the stock at about $1.10, and then I sold it off at $1.31. And the reason being why I sold the stock was because, based on my research, they were saying, look, we're going to convert these suites, we're going to sell them, we're going to revalue them. But based on my research, at the rate at which the expenses were increasing, and also at the rate which they were selling their suites, which was, I think, slower than what management had forecasted, along with the fact that their expenses were increasing faster than the underlying profits, I thought that they were going to miss their earnings and essentially not have a good report, right? And so, you know, I was correct about that. And as you can see, they've dropped down to under what I bought it for at $1.07. Now, will I buy back? Probably not, because I just don't think management are executing on their 3-year plan as well as they said they would. Okay, maybe if it goes to 90 cents, 80 cents, I would, because that would be good value, because New Zealand has a lot of old people. A lot of people go there to retire. It's a great place, right? So based on that, that was, again, pretty good decision, but I'm not going to rush and buy back in. Okay, next stock, A2 Milk Company. So if you guys think back to a video I released a few months ago, you'll remember that I bought this before their annual general meeting, because, again, the company had got sold off due to irrational fears, saying, because they were upping their sales and marketing spend, they were actually losing market share, which wasn't the case, which was actually the opposite, because they were trying to accelerate their dominant position, and essentially they became the number 1 and 2 brands on Alibaba and JD.com. Okay, guys? So I bought the stock before the call, and it did very well. I ended up selling it off in February, and the reason why I did was because I thought that they were going to have some big supply chain disruptions due to the coronavirus. And in addition to that, I just wasn't too sure what the market was pricing in. But obviously that was a pretty bad call, because as you can see, they've continued to run up, because in their most recent half-year report, management have said, look, we have had no disruption because of the coronavirus. Our product is in very, very high demand. We are the premium infant product. If people are quarantined, they're still going to feed their babies, and they're not going to stop. So why would we have any problems? And in hindsight, they say hindsight's 2020, and that was a pretty bad call on my part. So not my best work, but you can't win them all. All right, guys. Moving on. So Turning Point Brands. This stock was a very, very quick trade that I did. Okay, so based on my research, the investment thesis was, I bought this a few days before the earnings call, and the investment thesis was that because of the electronic cigarettes and vaping black market, it has caused a bunch of vaping-related infectious lung disease deaths. Okay, now we have to separate. Turning Point Brands, they are a legit company, and they don't have any black market materials. But the black market vape liquids, especially in the vaping pods that were being released, there was a lot of dodgy shit being imported from factories like China, and basically it wasn't regulated, and there was a lot of chemicals in there causing a condition called EVALI, which was electronic and vaping associated lung infections. And as a result, what happened was people were dying, especially kids. We're talking kids between the ages of 15 to 17, except it wasn't being caused by the big companies like your Philip Morris's or your Altria's or your Turning Points. It was being caused by the electronic cigarette black market. However, the politicians jumped on top of the stock and said, look, all vaping is banned. We're going to ban vaping, etc., etc. And so what happened was the market had sold the stock off about 60, 65, 70%, because they were pricing in an outright ban on vaping. But obviously that wasn't correct, because what happened was they passed the laws, and Trump had actually vetoed the outright ban and only banned certain flavors, but also kept a lot of the other so they banned the pods, but they still have the cigarette pens and also the open chamber, mixture and liquids, right? And so as a result, the market was pricing an outright ban, whereas, my research showed me that that wasn't the case. Now, obviously, I wouldn't hold this long term because of all the regulatory uncertainties. However, this was a very nice trade, and so got in, got out, because I had a feeling they were going to beat the earnings call, the estimates on the call, and give good guidance. Now, they didn't beat the estimates, but they gave good guidance, which showed that vaping isn't just going to disappear and die overnight. So that was the thesis behind Turning Point Brands. All right, guys, moving on to next stock. Good old Boingo Wireless. Now, this was a company that I did some research back. This was a few months ago, and I bought in at $9.57 and actually sold out at $12, because whilst the earnings call was good, their multifamily segment was growing slower than I thought it would, which made me think that they might miss their next earnings call. However, the reason why I bought back in is because whilst they did miss their earnings call, what actually ended up happening was that they had a lot of people interested to potentially take this company over. And so that's the reason why I bought this back in, because usually when you get a takeover in the American markets, and sort of any market for that matter, the premium is usually between 40, 50 low end to sort of 60, 70 on the high end. And so I think that this would be a good arbitrage play. And I think the likelihood of Boingo being taken over is very, very high. And the reason being is because you've got, the likes of Verizon, Sprint and TNT, they just merged. AT&T, you've got all these people fighting each other for market share. And so as a result, Boingo is very attractive because they have all of the different sites. Yeah, they've got all the different airports hooked up. They've got the MTA, Metro Transport Association, something of New York. They've got the port authorities, right? They've got the trains, they've got the buses, and they've got pretty much all of the military hooked up in terms of their infrastructure. And so this is very attractive for somebody trying to win market share, especially now that Boingo's moving into multi-family apartments. And the rate of urbanization, I think it really just makes sense for a big player like Verizon or somebody else to go and acquire them. And so as a result, I bought back in because I am very confident that the acquisition will end up happening within the next sort of 3, 4, 5, 6 months. And it's not expensive to buy, right? Boingo is only about sort of 600 million market cap, so you're talking probably no more than $1 billion, maybe 1.2 billion to buy them. So yeah, look. Good little arbitrage play. Furthermore, it might not just be one of the telcos buying Boingo, but it could actually end up being one of the airlines. And the reason being is because, again, the competition for customer loyalty and market share is very fierce. And so you've got these airlines pretty much trying to offer the on-the-ground equivalent speeds of Wi-Fi while you're on the plane. And again, guys, if you do some research, good connectivity, that is absolutely massive for a customer when they decide who they fly with. All right, okay, guys, and who they continue to fly with. And so what we have something is called the gate-to-gate connectivity. And I think that with a lot of airlines moving into the space, pushing it hard, like your likes of Delta, your JetBlues, it could even be a good acquisition for an airline. So that's why I'm bought back into Boingo and holding it tight. All right, guys. And next two stocks that I bought, Geo Group and Core Civic. Okay, guys, and if you think back to the video that I made about a month ago, you'll see that I had a really, really good sort of bullish thesis for why I think these two companies will do well. And that's just purely because all of this negativity in the media around banning private prisons, that's physically impossible because of America's overcrowded prison systems and aging facilities. Okay, guys? So they have no option but not to use private prisons. And again, my research shows me that it's very unlikely that Trump will lose the election, and so he's very pro-private prisons. So I think that they're going to have a good re-rate after the November 2020 elections. Furthermore, Elizabeth Warren, right? She's actually just withdrawn from the presidential race, which is even better for Core Civic and Geo, because her and Alexandria Ocasio-Cortez, they were hammering the whole, we're going to ban private prisons, we're going to ban private prisons. Well, now she's out of the running for the race, and so that's even better for Core Civic and Geo. So I might even buy some more if they continue to drop. But as you guys can see here, I've been collecting some nice, yummy dividends from these guys. At their current price, they're paying about a 11, 12, 13% dividend. And, they've actually continued to raise the dividends, and their funds from operations and adjusted funds from operations have continued to increase. So I don't think the dividends are at any risk. We've got Warren, who's dropped out. So, yeah, look, everything is looking good for these guys. So unless we head into a massive market crash and a recession, I think Trump's probably going to get re-elected. So, yeah, it'll be a good time. All right, guys, and final stock that I bought back into, which is Weight Watchers. As you can see, I've been in and out of Weight Watchers. I bought them back at the lows of 20.71. They had a great earnings call, and then they ran all the way up to $40, at which point I sold the rest of my position. So I sold half at about mid-30s, sold the rest of my position at $40, and now I've bought back in, and I do plan to average down as the market continues to get sold off because of the coronavirus. And the reason being is because if you guys have been following Weight Watchers lately, you've had Oprah touring. She's invited Dwayne "The Rock" Johnson. She's invited Kate Hudson. She's invited a lot of people to tour a lot of places, and that's actually by far exceeded the expectations where I thought they would actually end up in terms of their subscriber numbers and especially their guidance, right? You know, they did 1.4 billion this year and they're guiding 1.6 billion next year. So that's about a 14-15% revenue growth on top of you know, they did 1.70 EPS this year and they're guiding 2.15 to 2.40. So even at the midpoint, we're looking at least 2.25 of EPS. That's almost a 30% EPS growth, okay, guys? So that's, sorry, that's wrong. That's almost 25% EPS growth, okay, guys? So they've beat the street estimates for both earnings and revenue. Their subscriber numbers are way ahead in terms of expectations, and their guidance is absolutely amazing. And they've basically got sold off into oblivion, okay, because of the whole coronavirus situation. And I can understand why people are selling Weight Watchers off, because they're going to say, well, look, you know, if you're all in quarantine, how are you going to leave your house to go to the meetings to go and lose weight, right? You're not. You're going to stay at home and get fat. And I think that bare thesis is wrong, because if you truly dig deep into Weight Watchers' business model, you'll actually realize that the majority of their subscribers are digital subscribers, and they're very, very actively engaging with their own internal Weight Watchers related social media. You know, they get tens of millions of posts per month, and everybody's engaging. So I think that if we all end up being locked up in quarantine like Wuhan, everybody's still going to lose weight. In fact, they're going to be even more motivated to lose weight, because by the time they get out of quarantine, they're obviously going to mingle, go to parties. They're going to make up for lost time and go to a lot of things that they weren't able to do when they're quarantined. Okay, now I don't think we're going to get to that draconian state where, you know, all of America gets quarantined, but if it does, I think people are still going to engage, lose weight. I mean, what else are they going to do? They're going to be at home all day, right? So you might as well do some training. I mean, you know, where else are you going to go? So that's the reason why I bought back in, and unfortunately it's dropped about 15% since I bought back in. But look, I think that they're going to do well, and I think when the market starts to realize that this whole coronavirus thing isn't actually going to kill half of the USA, that they're going to start going back up. So I do plan to average down on my buy maybe 1 or 2 more times, and then watch the stock go up. If it's not 2020, late 2020, early 2021. All right, guys, so that's the end of the video. Look, I'd be really interested to hear what stocks you've been buying, what stocks you've been selling, and what's on your watch list. Guys, next week, what I plan to do is I plan to show you some of the stocks on my watch list and really just take you through the reasons why I'm watching these stocks and where I plan to get in, because there are a lot of stocks that are down 50, 60%, and I think that they'll be very good value once this whole coronavirus thing blows over. So until next time, happy investing.